Welcome back to the channel. Today we're taking a deep, long-form dive into three of the most widely discussed income-focused ETFs expected to perform strongly in 2026. Pick the Goldman Sachs Nasdaq 100 Premium Income ETF, QQQI, the NEOS Nasdaq 100 High Income ETF, and SPYI, the NEOS S&P 500 High Income ETF. Investors today want two things that rarely travel together: high income and long-term NAV stability. Traditionally, high-yield products sacrifice NAV, eroding long-term wealth. But these three ETFs represent a more modern, actively managed approach that attempts to deliver competitive yield while maintaining the underlying value of the fund. We'll cover how each ETF works, how they attempt to avoid NAV decay, how they generate yield, their risks, their tax implications, what to expect in 2026, and which investor types may benefit most. By the end of this video, you'll have a complete understanding of how GPIQ, QQQI, and SPYI differ, even though they all use premium income option overlays, and how they might fit into a stable income portfolio. Let's begin with the foundation of these ETFs, what premium income strategies are, and why they matter. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. At the heart of all three ETFs is a simple concept: using options premium to generate recurring income. Premium income ETFs typically write call options on the underlying index or portfolio. When you sell a call, you collect upfront cash, which becomes distributable income. The trade-off is that you give up some upside if the market rallies. In older buy-write ETFs like KYLD or XYLD, the problem was that they sold calls aggressively at the money every month, which throttled upside so much that NAV slowly bled downward over years. Their yields were high, but NAV decay made investors poorer. Modern ETFs, like the ones we're analyzing today, operate differently. They use dynamic call writing, call spreads, index options, active volatility management, and tax-efficient overlays to generate income without constantly sacrificing future growth. These funds usually aim to generate income through index call writing, optimizing strike distances, using volatility to their advantage, managing exposure, and tax-efficient gains harvesting through Section 1256 contracts. The key point is, these ETFs try to preserve NAV while paying monthly income. It's not guaranteed, but the design is more protective than traditional strategies. With that in mind, let's begin with the first fund, PIC. PIC is Goldman's flagship premium income ETF built around the Nasdaq 100. It launched in 2023 and quickly gained billions in assets under management. The appeal is simple: it offers exposure to top tech companies while generating regular monthly distributions using a dynamic options overlay. Unlike static covered call products, PIC changes how much upside it sells depending on market conditions. When volatility spikes, they write fewer calls to leave more upside exposure. When volatility falls, they write more calls to boost income. This dynamic approach matters greatly, because static strategies often give up way too much upside during bull markets, resulting in NAV decay. Goldman's system tries to counteract that by scaling exposure intelligently. PIC's holdings look similar to QQQ, Apple, Microsoft, Nvidia, Amazon, Broadcom, and Alphabet dominate. The underlying equities provide strong long-term growth potential, something that high-yield funds historically lacked. On the distribution side, PIC pays monthly and often classifies a large portion of its yield as return of capital, ROC. Many investors misunderstand ROC. It is not necessarily destructive. Much of it comes from option premium, essentially a tax deferral mechanism, which allows income to be paid without the IRS counting it as immediate taxable income. Risk-wise, PIC still holds high beta technology stocks. If the Nasdaq 100 experiences a deep downturn, PIC will fall with it. The premium overlay softens declines but does not shield from major drawdowns. Like any equity income ETF, it trades off upside for income. But among Nasdaq-focused yield ETFs, PIC has one of the more modern NAV preservation architectures. As we look toward 2026, PIC is well positioned if volatility remains elevated, because that environment generates higher premiums. And in tech-driven growth cycles, dynamic options allow it to capture more of the upside. Next, let's turn to QQQI, one of the most popular high-income ETFs today. QQQI is one of NEOS's fastest-growing funds and has become extremely popular because of its ultra-high yield, often in the 12 to 14% range. Like PIC, QQQI uses the Nasdaq 100 as its underlying index. Both funds own nearly identical core holdings, but their income engines differ. QQQI uses index options on the Nasdaq 100, specifically Section 1256 contracts, which are taxed under the 60-40 rule, 60% long-term capital gains and 40% short-term. This makes QQQI unusually tax-efficient for an income ETF. Even better, QQQI's distributions often classify heavily as return of capital, enabling further tax deferral. Many investors incorrectly fear ROC, thinking it means the fund is paying you back your own money. But in these modern ETFs, ROC generally results from the handling of options premiums rather than from destructive returns. As long as NAV remains stable or grows modestly, ROC is typically benign and even advantageous. One of QQQI's strengths is its active options management, which adjusts strike prices and expirations based on volatility signals. Unlike traditional covered call ETFs, QQQI aims to leave meaningful upside potential. As a result, it tends to outperform older buy-right ETFs in rising markets. But there are trade-offs. QQQI has one of the highest expense ratios among premium income ETFs. The high yield also comes with underlying tech volatility. And although NAV decay is less likely than with pure at-the-money static strategies, it's still a possibility if the market stays flat and volatility remains low. Looking at 2026, QQQI benefits most from a moderate volatility, upward trending Nasdaq market. In those conditions, options premiums remain high while equities grow steadily. That combination supports both income and NAV. Now let's shift from Nasdaq 100 income plays to the broader S&P 500 with SPYI. SPYI is NEOS's S&P 500 based version of QQQI. It uses a similar tax-efficient option overlay but applies it to the SPX index. Investors flock to SPYI because it blends broad market stability with high monthly distributions. SPYI uses call spreads, rather than simple covered calls, and this can help preserve upside better than selling naked calls. In a call spread, the fund sells a call at one strike price and buys another call at a higher strike. This structure generates income but doesn't cap upside as aggressively as writing a single call. Just like QQQI, SPYI uses Section 1256 options, giving it the 60-40 tax split. SPYI also tends to classify a very large percentage of its distribution as return of capital. For many investors, especially those in high tax brackets, this is an extremely appealing feature. Because SPYI uses the S&P 500 instead of the Nasdaq 100, its risk profile is more moderate. The S&P 500 includes financials, healthcare, industrials, consumer staples, and energy, sectors that historically show lower volatility. SPYI tends to experience less dramatic swings than Nasdaq-focused income ETFs. That makes it potentially more suitable for investors seeking steady monthly income with lower volatility. In terms of NAV preservation, SPYI arguably has the strongest foundation among the three funds. Its exposure is diversified, its option strategy is spread-based rather than pure buy-right, and its income is supported by both option premiums and broad market stability. In 2026, SPYI will likely benefit from steady market growth and controlled volatility. It is the most balanced of the three ETFs and appeals to investors who want high yield but are uncomfortable relying solely on tech stocks. Let's compare all three ETFs across core categories. Underlying index, pick Nasdaq 100, QQQI Nasdaq 100, SPYI S&P 500 Yield potential, QQQI highest, often 13 to 14%, SPYI high, often 10 to 12%, pick moderate high, often 8 to 10% NAV preservation design, pick dynamic call writing strategy, QQQI 1256 options plus active strikes, SPY call spreads plus diversified S&P 500 base upside potential, pick good, due to dynamic overlay, QQQI moderate, SPY most consistent volatility risk, pick high, QQQI high, SPY moderate tax efficiency, QQQI extremely strong, SPY extremely strong, pick strong but more ROC-dependent investor fit, pick those who want yield from tech plus upside capture, QQQI those seeking maximum monthly income, SPY those wanting stable income with lower risk. Even though these ETFs aim to prevent NAV decay, it can still occur. Several market conditions may challenge their strategies. Long periods of low volatility, option premiums fall and yield may drop. Strong bull markets, upside is capped, NAV growth lags pure index ETFs. Sharp bear markets, holdings decline sharply despite option premiums. Tax-adjusted cost basis issues, ROC lowers cost basis and may create future tax liabilities. Investor misunderstanding of ROC, may panic unnecessarily. Over-allocation to income ETFs, can reduce long-term growth. That said, these ETFs are fundamentally built to manage volatility, capture some upside, and pay recurring income. They are designed for steady, long-term, income-oriented investors. Looking ahead to 2026, several factors can influence these ETFs. A moderately volatile market would benefit all three funds. A rising Nasdaq will strongly benefit PIC and QQQI. Broad market growth will support SPYI's NAV stability. A recession or high volatility bear market will hurt all ETFs, though SPYI likely the least. Tax changes regarding 1,256 contracts could affect QQQI and SPYI more than PIC. Assuming markets exhibit typical volatility and gradual upward movement, 2026 looks favorable for these ETFs. They may continue delivering stable or rising distributions and controlled NAV behavior. PIC, QQQI, and SPYI are three of the most advanced income ETFs available today. They represent a new generation of premium income solutions that aim to avoid the NAV decay that plagued earlier buy-right strategies. PIC is optimized for tech-driven growth with dynamic call overlays. QQQI focuses on maximum income with active strike management and tax efficiency. SPYI offers high yield with broad market stability and the lowest volatility of the three. No ETF is perfect, and every income strategy has trade-offs. But for investors seeking high monthly income with controlled NAV behavior, these three stand out as some of the most compelling solutions heading into 2026. Thank you for watching this in-depth analysis. If you enjoyed this content, be sure to like, subscribe, and comment which ETF you prefer, or which one you want to learn more about next.